Hey, welcome to this episode of InvestU. Today we're going to be doing a deep dive into the electronics arts stock. So a bit of basic info about this stock. The ticker is EA. It's traded on the NASDAQ. This analysis was performed on the 29th of April 2020. It has a market cap of $32.3 billion, and the stock price right now is $111.35, and the number of shares outstanding are 290 million. So we've listed our investing rules here, which we'll post in the show notes below, and these are the rules we abide by to ensure that the stock we're looking at meets our criteria for a value stock, and it's something we're interested in. Diving into some of the metrics for EA, the price right now, as mentioned, is $111.35. It has a PE ratio of 11.24 and an earnings per share of 9.50, which translates into about a 9% return. It has a dividend yield of 0%, which makes sense for a tech stock, a price to book of 460, which provides a margin of safety of only 22%. This is less than what we're looking for per our investing rules, but we'll dig into this and do some comparisons to some competitors and peers in its marketplace to see if they have similar price to book. Has a great debt to equity of 0.15, really good return on equity of 28.3%. Strong current ratio, which is especially important in this day and age, of 2.82, an EV over EBITDA of 22.61, which suggests it's slightly overpriced, and it is correlated to the S&P 500 about 48%. It does have a lower correlation to Walmart and Apple stocks. One of the things I like to look into, especially with tech stocks, is the shares outstanding. What I like to see is a decreasing or steady number of shares for tech stocks. The concern I would have is with tech stocks, they tend to finance their activities through dilution of shares. So what I mean by that is they issue additional shares to fund their activities, and as a investor, your worth of your shares over time gets diluted. With taking a look at EA, we see generally a downwards trend here if we try to draw a linear profile to it, and it's been fairly steady and slightly decreasing over the past few years. And if we look at the shares outstanding right now, about 290 million, that trend is continuing for decreasing shares. Taking a look at the value over time, we see steady revenue, net income, and total asset growth, which is definitely a positive. The liabilities and debt are kind of stagnant. We see some slight increases around the 2015 timeframe, and it's kind of tapering off since then. The total shareholders' equity is increasing over time, as we expect with a constant debt and liability, but with assets increasing. And the shares outstanding are decreasing over the past few years, and we're continuing to see that trend as there's only 290 million shares outstanding at this point in time. So doing a comparison with its peers, it has the strongest PE ratio amongst the group. Excellent return on equity up there with the top few companies. Price to book generally in line with its peers, maybe a little bit on the low side. Really good current ratio, but as does its peers in this group. And a good debt to equity. As mentioned, there is very little debt on the books relative to equity for this company, so that's a positive thing. While this meets a lot of criteria for value stock, from a growth perspective, it's not a huge amount of growth when we look at a 10-year window. And when we do our intrinsic value calculation, we take a 3% growth rate. We discount this at 10%, growth rate in perpetuity of 2%, and using the 2019 free cash flow, we arrive using a discounted cash flow model of a 64.62 intrinsic value. If we do a simple book value growth approach, we arrive at something that's closer to the share price of $126.35. So I would expect the intrinsic value would be somewhere in between there. The concern I have right now is, again, the shares are trading at $111.35. So we're kind of close to the book value growth approach, but we've greatly exceeded the discounted cash flow approach. So at this point in time for EA, I think I would add this to my watch list because it does tick a number of boxes from a value investing standpoint, but it is exceeding the intrinsic value. So it would be a stock that I am concerned about. Okay, digging into the annual report, and we'll go through a couple positives and negatives here. From a positive point of view, it recently announced partnership with Google Stadia to get its games on that platform. With low interest rates, the ability for this company to license royalties is definitely a positive, and its borrowing costs will go down. The company has strong recurring revenue from Madden, FIFA, and NHL, so that's a positive. We see good year-over-year revenue from those sources of games. And remember, at a younger age, wanting to buy that Madden game every time it came out, you have to get the new one with the new rosters. So I'm sure that that trend is continuing. It does support multi-platform gaming. It supports mobile, PS4, Xbox, PC gaming. So it's across all platforms. And I would suspect that there is an increase in gaming during the pandemic. So obviously this is an entertainment source. We've seen stocks like Netflix increase in popularity recently, and I would suspect that EA is also increasing, and younger individuals are looking towards video games as their source of entertainment during the pandemic. From a negative perspective, this is a highly cyclical industry with a large volume of purchases happening in Q3 due to the Christmas season. It's a highly competitive marketplace with potential disruptors. It's reliant on a strong entertainment industry, which in this day and age is very weak, and impacts to things like sports season shutting down, movies that they make video games of maybe not taking place at the same time really could hurt their bottom line. Development of recurring revenue games may be limited during COVID-19. I would suspect that this company in particular might be a month or two behind. Perhaps there's some work that this company can be doing from home, like many of us are doing, but I would be concerned that they're not developing things at the same rate that they once were, and that is listed as a risk on their annual report. And in general, a risk is their packaged goods sold to a small number of retailers, so they're really relying on the supply chain of those retailers and those stores being open to help sell these goods. So again, going back to the intrinsic value calculation, using a growth of 3%, discounting it at 10%, a growth rate of perpetuity of 2%, using a discounted cash flow approach, we arrive at an intrinsic value of 64.62, and using a book value growth approach, we arrive at an intrinsic value of 126.35. So as a result, EA is a stock that I would have on my watch list. However, this is not a stock that I'd be investing in at this present point in time. I think $111 is getting kind of close to the intrinsic value, and I want to be looking for something that is less than the intrinsic value and is being sold at a discount. Great company, great products, really, really good, strong financials here, but this is something I would have on my watch list at this point in time. Thanks for tuning into this episode of InvestU. Please click subscribe below and shoot us an email at valueinvestu@gmail.com, and we'll send you a copy of our stock analysis program, which helps perform similar analysis on tickers of your choice.